Hello fellow intelligent investors. So in this video, I want to outline why in the short term, Alibaba's business might be harmed by the actions taken by Chinese regulators, but that Alibaba's business fundamentals may actually be strengthened if you are willing to take a longer term view. As Thomas Russo wrote in his recent investor letter, Alibaba's shareholders should financially benefit from such reforms. So without further ado, let's get started. So, after I've given you a general overview of the actions taken by the Chinese government over the last few months in my last video, in this video I will solely focus on the thesis that Alibaba will navigate through the regulatory challenges and emerge even stronger. And I will focus on 4 aspects to highlight how Alibaba investors can view the recent regulatory scrutiny in a more positive light. And namely, I will discuss whether Alibaba can still be considered an accounting fraud, how Baba's e-commerce business is affected, how the financial empire Antgroup benefits from the financial restructuring demands, and finally, how Alibaba is incentivized to heavily invest in its future. Alright, so I will start with investors' worries whether Alibaba's profits are actually real. Voices that Alibaba is a gigantic fraud have frequently been voiced in the past. And critics have pointed out that many of the metrics presented by Alibaba are, quote, fake, and that some of the numbers seem, quote, too good to be true. Already back in 2015, Alibaba was reporting more customers than Amazon, reporting more deliveries than UPS, and growing faster than Facebook and Google. And their GMV per employee numbers also looked outright insane. Well, I think as investors, we should first and foremost focus on cash flow. So are Alibaba's reported revenue and profit figures real? Well, if there's one good thing about Chinese regulatory scrutiny, I think it is that it should give investors confidence that Alibaba's profit numbers are indeed real. For example, their $2.8 billion fine represented almost 14% of the firm's 2020 free cash flow. And the now announced $15 billion prosperity pledge is larger than Alibaba's current fiscal year operating profits. So either the numbers are real, or as Twitter user Value Investigator puts it, this is a government-supported stunt to hide fake earnings. And moreover, investors also have to acknowledge that Alibaba has been audited by the global accounting firm PricewaterhouseCoopers for more than 20 years now. And this is one of the big 4 global accounting firms. And to quote from Robert Vinal's letter once again, a further criticism of Alibaba is that the accounting does not reflect the underlying economics of its business. It strikes me as highly implausible that the dominant e-commerce marketplace in the world's most populous country is not spectacularly profitable. The extent of said profitability might reasonably be debated, but not its existence. Next, I want to focus on Alibaba's e-commerce business. And this is maybe the most important area to consider for investors, as core commerce, as defined by Alibaba, represents 87% of total revenue. Personally, I believe that the e-commerce business has not been permanently impaired. Sure, in the short term, Chinese regulators banning the choose one from two practice will hurt Alibaba. So again, this policy punished merchants who operate online stores both on Alibaba and on rivaling platforms, or run promotions at the same time on different platforms. And if you think about it from a consumer and business innovation perspective, banning this policy makes a lot of sense. It doesn't get much more monopolistic if you ask me. Now, if you are worried about Alibaba's e-commerce business, I think you need to ask yourself whether Alibaba's e-commerce business is or was so strong and dominant because of this practice, or are there maybe other factors at play that protect its business and profitability? Well, Alibaba aggregates almost 1 billion Chinese consumers and roughly 260 million additional consumers outside of China. And it connects them either to consumers that wish to buy or sell items on Taobao, or to businesses through its B2C platform Tmall. Thus, Alibaba certainly benefits from other competitive advantages, such as network effects, habit-based purchases, consumers trusting their platforms. And so even without the choose one from two practice, I think Alibaba will continue to be a primary dominant e-commerce platform in China. And again, Robert Vinal concludes in his letter, Alibaba derives its market power from other sources, most importantly aggregating huge demand. As such, I'm skeptical the impact will be that great. Amazon seems to be doing fine in the West without choose one. Alright, next up I want to focus on or discuss Alibaba's stake in Antgroup. Alibaba has a 30% stake in the company that owns China's largest digital payment platform, Alipay. And before the IPO of Antgroup was cancelled last year, the firm was valued at over $300 billion. But it was then ordered to be restructured as a financial entity to reduce systemic risks. But why? Well, put in a nutshell, in early 2021, loans offered by Antgroup accounted for nearly 1/5 of China's outstanding short-term consumer debt. And they did so without any capital requirements. And maybe for starters, capital requirements are regulatory standards for banks that determine how much liquid capital, so capital that is readily available, they must keep on hand. So was there systemic risk caused by these circumstances? I would certainly think so. They had to act more responsibly and they also had to protect consumers more. So being subject to capital requirements, similar to a bank, makes a lot of sense to me. And both Thomas Russo and Robert Vinal, they too think the changes Antgroup has to go through make a lot of sense and will strengthen Alibaba in the long run. Here's what Russo wrote in his letter. Ant Financial was using traditional Chinese capital to fund their consumer purchase loans and was able to underwrite with limited financial reserves. More importantly, there were no credit checks available at the time to even begin to measure risks, which Ant Financial presented by the time it reached its peak just prior to its collapsed IPO. Ant Financial had a credit scoring system untested in a recession. Regulators did not know if Ant Financial's security would work in a downturn and feared the rapid growth of such loans. Today, Alibaba actually benefits from the financial system protection against Ant Financial's prior risks of lending, with little idea of credit risks. And Robert Vinal wrote, this was a disaster waiting to happen and was untenable from a regulatory perspective. Potential shareholders in Ant can be thankful that regulators did not wait until after the IPO to announce their actions. It was a shareholder-friendly move for which they have received little credit. As a result of the changes, Ant will most likely have to retain 30% of the loans in intermediates and hold appropriate levels of capital against them. The consensus is that this makes the business less valuable, as it will slow down growth and bind greater levels of capital. This may turn out to be the case. However, it may also make the business more valuable in the long run by better aligning the interests of consumers, banks, and Ant around responsible lending and ensuring that Ant is appropriately capitalized to withstand periods of economic volatility. And then finally, one might mention that generally there is a perceived government pressure to invest heavily in future technologies and innovation. Beijing has welcomed domestic investments, and as a result, Alibaba has pledged to dramatically enhance investments and domestic spending. Alibaba CEO Daniel Zhang said after the most recent quarter, we announced a plan to invest all of our incremental profit this year into core strategic areas, such as technology innovation, support programs for merchants to lower their operating cost, user acquisition and experience enhancement, merchandising and supply chain capabilities, infrastructure development, and new business initiatives. And of course, this may slow down profit growth in the short term. Net profits declined 8% last quarter, and Alibaba's operating margin narrowed from 23% to 15%. As Baba stepped up investments in new businesses. But as shareholders, all we should focus on is growth in free cash flow per share over the long run. So I think prioritizing value-creating investments is actually a good thing for long-term investors. And Thomas Russo wrote, "During decades of Alibaba's greatest growth, Mr. Ma evidenced a preference for taking on projects which, more often than not, eroded reported profits as investments he selected for greatest long-term growth in intrinsic value on a per-share basis, burdened reported profits in the near term." Take Ali Cloud, for example. As of 2021, Alibaba's cloud business represents almost 10% of total revenue. And this business division is still not profitable, but likely turning profitable sometime soon. And it is growing very quickly too. It's the third largest cloud provider behind Microsoft Azure and AWS. And I believe at scale it is likely to be a highly profitable, high margin business with huge barriers to entry. So reinvesting profits in this space, for example, is something long-term investors should love to see. And to quote Robert Vinal one final time, "If Alibaba Cloud follows the same trajectory as AWS, it could easily become as valuable as Alibaba's marketplaces business today. It is due to turn profitable this year, so it is on the right track." So what's the bottom line here? Of course, there are risks. Autocratic decisions that need no public authorization are something many people are not used to in the West, and it is hard to predict, or maybe I should say impossible to say, what the Chinese Communist Party will decide in the future. We also haven't talked about the risk of confiscation, the risks that come with the VIE structure, so the variable interest entity structure, meaning that investors do not technically have an ownership stake in the underlying businesses. And we also haven't discussed the delisting risk in the US. However, when I'm confronted with all of these bearish China and Alibaba headlines, I always have to think of Ned Friedman, CEO of GitHub, who said, "Pessimists sound smart, optimists make money." I think I have shown 4 examples that illustrate how the Chinese regulatory actions have disrupted certain business areas of Alibaba in the short and maybe near term, but will make the business stronger if you are willing to take a longer term view. And I think Thomas Russo summarized it fabulously in his letter. He wrote, "We believe, however, that Alibaba will financially recover from near-term disruptions and once again evidence the extremely crucial role Alibaba has long played in Chinese commerce. I believe this is to be the case given the following advantages it possesses, i.e. the financial strength of Alibaba, its dominance in commerce platforms that continue to be indispensable for its manufacturers and merchants, its commitment to invest heavily in new ventures, even when such investments cause near-term results to, quote, suffer, its robust and fast-growing cloud business, and its prospects for enhanced business practices that I believe will arise from many of the very same reforms that are being poorly received by equity investors today." I think even though Alibaba's business is confronted with certain political, economic and regulatory headwinds, there's a good chance that the business itself will continue to do well in the future. At the end of the day, it's cash flow, not news flow, that creates sustainable shareholder value. And you get all of this right now at a low to mid-teen free cash flow multiple, which seems attractive considering the firm's ability to reinvest its profits into, value-creating projects. And having a CEO that also buys back shares when the business trades at low, valuation multiples. But as always, this is just my personal opinion. And of course, you have to do your own due diligence. And as I've said, there are certainly risks that are somewhat hard, if not impossible, to predict. And with that, I think we can wrap it up here. As always, may your finances and investments prosper. Good luck.